recent months, a growing narrative has circulated among investors suggesting that a structural transformation of the global monetary system may weaken the long-standing role of gold and silver as safe haven assets. The argument sounds sophisticated. It references digital currencies, capital mobility, geopolitical fragmentation, and policy intervention as forces reshaping how value is stored worldwide. But when examined carefully through a macro-financial lens, the conclusion does not follow from the evidence. In reality, the very structural shifts being described are not bearish for precious metals. They are precisely the conditions under which gold historically performs best. The first misconception lies in the interpretation of systemic change itself. Monetary transitions do not eliminate neutral reserve assets. They increase demand for them. Whenever confidence in dominant settlement frameworks weakens, even gradually, institutions begin diversifying into politically neutral stores of value. That asset, historically and structurally, has always been gold. Today's environment reflects exactly such a transition. Central bank balance sheets remain historically elevated. Sovereign debt ratios across developed economies sit near record levels. Fiscal expansion has shifted from emergency policy to structural policy. These are not signals of stabilization. They are signals of dependency on liquidity support mechanisms that reduce long-term currency credibility. And when credibility becomes uncertain, diversification begins. Gold does not require inflation to rise dramatically to perform well. It requires confidence in monetary stewardship to weaken gradually. That process is already underway. The second misunderstanding concerns the role of liquidity. It is true that capital now moves faster than it did 20 years ago. It is true that cross-border flows can react instantly to policy signals, but speed of movement does not reduce the attractiveness of reserve assets. It increases volatility in risk assets and strengthens demand for stability anchors within portfolios. Institutions managing large capital pools cannot rely exclusively on yield-seeking instruments in a structurally unstable monetary environment. They require assets that are politically neutral, globally accepted, and not dependent on counterparty performance. Digital settlement systems may improve transaction efficiency. They do not replace trust. Gold remains the only reserve asset outside the liabilities of another institution. That distinction has never been more important than it is today. Another frequently repeated claim is that alternative payment systems and emerging currency blocks reduce the relevance of precious metals. Yet historically, multipolar currency environments increase, not decrease, the role of neutral settlement assets. When reserve dominance fragments, countries hedge exposure to each other's currencies. They hedge with gold. This trend is already visible in central bank accumulation patterns across emerging markets. Reserve diversification is no longer theoretical. It is measurable. And unlike retail positioning, central bank allocation decisions reflect long-term structural planning rather than short-term sentiment shifts. When sovereign institutions accumulate an asset persistently across cycles, it signals strategic importance, not temporary preference. A third assumption worth challenging is the belief that policymakers can successfully manage perception indefinitely. Modern monetary authorities influence expectations more actively than in previous decades. That is undeniable. But managing expectations is not the same as controlling structural outcomes. Confidence engineering works best during cyclical slowdowns, not during regime transitions. When debt expansion becomes structural rather than temporary, narrative management loses effectiveness over time. Gold performs strongest precisely in those environments where policy credibility remains intact on the surface, but weakens underneath. Markets rarely react immediately to such transitions. They adjust gradually, then suddenly. Another overlooked factor is the interpretation of competition from digital assets. It is increasingly common to frame tokenized finance as a rival to precious metals. Yet this comparison misunderstands the role metals play inside institutional portfolios. Gold is not competing with technology platforms. Gold is competing with sovereign risk exposure. Digital assets depend on infrastructure, regulatory frameworks, and network trust. Gold depends on none of these. Its value does not derive from usability alone. It derives from independence. In periods where financial architecture itself becomes uncertain, independence becomes premium. That premium is rising, not falling. Perhaps the most important misconception embedded in the bearish interpretation of global monetary transition is the assumption that structural change reduces the relevance of historical safe haven behavior. History suggests the opposite. Every major monetary transition, from the collapse of Bretton Woods to the inflationary cycles of the 1970s to the post-2008 liquidity regime, has strengthened the role of gold rather than weakened it. System transitions do not eliminate hedges. They redefine their importance. And today's transition appears to be no exception. Rather than signaling the end of the precious metals cycle, the emerging monetary landscape is laying the foundation for a new phase in which gold and silver function less as reactionary crisis assets and more as strategic reserve anchors inside a fragmented global financial order. Understanding that distinction is critical, because investors who interpret structural change as a reason to reduce exposure may be positioning themselves opposite the very flows that shape the next decade of capital allocation. A growing number of analysts argue that gold and silver can no longer be considered reliable protection assets in the modern financial system. Their reasoning is built on the observation that markets now react faster, capital rotates more aggressively, and policymakers intervene more directly than in previous decades. At first glance, that argument sounds persuasive, but it overlooks how institutional risk management actually works. Gold and silver were never designed to function as short-term volatility shields. They were designed to function as systemic insurance against structural instability. Confusing these two roles leads to incorrect conclusions about their effectiveness. In modern markets, protection is no longer defined by whether an asset rises immediately during stress. Protection is defined by whether an asset preserves purchasing power across policy cycles. And by that definition, precious metals remain unmatched. One of the most frequently misunderstood dynamics in crisis environments is the temporary liquidation phase that occurs at the beginning of market stress events. During these periods, investors often sell their most liquid assets, not their weakest ones. Gold and silver sometimes decline in these early phases precisely because they are among the few assets that can be converted into cash quickly. This behavior is not evidence of weakness. It is evidence of liquidity strength. Institutions do not sell gold because they distrust it. They sell gold because it works as collateral. After the liquidity shock stabilizes, capital historically rotates back into metals as confidence in financial intermediaries weakens. That sequence has repeated across multiple crisis cycles over the past half-century. The assumption that metals must rise immediately to remain effective hedges reflects a misunderstanding of how professional portfolios operate. Another argument often presented is that policymakers now actively manage market perception, reducing the need for traditional safe haven assets. It is certainly true that central banks attempt to stabilize expectations through communication strategy and liquidity programs. However, perception management has limits. Narratives influence sentiment. Balance sheets influence reality. When debt expansion becomes structural rather than temporary, confidence cannot be engineered indefinitely. Investors eventually begin reallocating capital toward assets outside policy reach. Gold occupies a unique position in this process because it sits beyond the liabilities of any government or institution. That independence cannot be replicated through policy tools. In fact, the deeper policymakers intervene to maintain stability, the stronger the long-term case for reserve diversification becomes. Investors are not abandoning protection assets. They are redefining which forms of protection matter most. Another overlooked issue in the argument against metals concerns the distinction between physical ownership and financial flexibility. Critics often claim that physical gold lacks speed compared to modern digital financial instruments. While technically correct, this observation misunderstands the layered structure of institutional portfolios. Strategic reserves are not supposed to move quickly. They are supposed to remain reliable when everything else moves too quickly. Speed belongs to tactical allocation layers. Stability belongs to reserve layers. Gold operates inside the second category, which becomes more valuable, not less valuable, when markets accelerate. Silver introduces a different but equally important dimension to this discussion. Unlike gold, silver participates in both monetary and industrial demand cycles. Some analysts interpret this dual role as a vulnerability. In reality, it is a diversification advantage. Industrial demand ties silver to technological expansion, energy transition infrastructure, and electronics production. Monetary demand ties silver to investor protection behavior. This dual exposure allows silver to benefit from both growth cycles and defensive positioning regimes. Rather than weakening silver's role, the global restructuring of supply chains and strategic resource planning may increase its relevance over time. Another claim frequently repeated is that metals now face competition from digital assets and alternative yield instruments. While this is partially true in speculative allocation segments, it does not apply to strategic reserve allocation. Digital assets compete for attention. Gold competes for trust, and trust remains the foundation of reserve strategy. Institutional capital does not allocate to gold because it offers yield. It allocates to gold because it reduces dependency risk inside a portfolio dominated by financial assets issued by counterparties. That function has not disappeared. It has become more important as financial complexity increases. Perhaps the most important misunderstanding behind the argument that metals are losing their safe haven status is the assumption that safety must always be visible in short-term price behavior. In reality, safety often appears invisible until systemic pressure builds. Precious metals rarely outperform during periods of maximum confidence. They outperform during periods when confidence begins to fracture quietly beneath the surface. And today's monetary environment shows exactly those early characteristics. Rather than losing relevance inside the modern financial system, gold and silver are transitioning from reactive crisis hedges into strategic allocation anchors designed to operate inside a world where liquidity is abundant, debt is permanent, and currency credibility is increasingly relative rather than absolute. Understanding this transition is essential for investors attempting to position themselves ahead of structural capital flows rather than reacting after they become obvious. One of the most persuasive arguments often presented against gold and silver today is that global currency competition, derivatives markets, and algorithmic trading have transformed the structure of capital flows so deeply that traditional safe haven behavior no longer applies. At first glance, this appears reasonable. Modern markets are faster, more leveraged, and more interconnected than at any point in financial history. Price discovery now occurs across futures exchanges, options markets, cross-border liquidity channels, and algorithmic execution frameworks operating at speeds measured in milliseconds. But speed does not eliminate structural demand. It amplifies the need for neutral reserve anchors. Currency competition, in particular, is frequently misunderstood by investors who interpret it only through the lens of exchange rates. In reality, currency competition is not about short-term valuation differences between national units. It is about strategic positioning inside the global settlement architecture. When countries begin reducing reliance on a single reserve currency system, they must increase exposure to politically neutral assets that function outside bilateral trust constraints. Historically, that asset has always been gold. Reserve diversification is not theoretical speculation. It is observable behavior across multiple central banks adjusting their long-term allocation strategies. These decisions are not reactions to daily volatility. They are responses to structural uncertainty surrounding future settlement frameworks. As monetary systems become more multipolar, neutral reserve assets become more important, not less. Another frequently cited concern is the increasing role of derivatives markets in shaping gold and silver price behavior. Futures contracts, option structures, and leveraged positioning often produce sharp price swings that appear disconnected from underlying physical demand. Some investors interpret this volatility as evidence that metals are losing their fundamental support base. In reality, derivatives markets increase liquidity depth rather than weaken structural demand. Institutional investors require scalable exposure before they commit capital. Without derivatives infrastructure, metals would remain niche allocation tools rather than global reserve assets. The presence of futures markets allows central banks, sovereign funds, and macro portfolios to adjust positioning efficiently without disrupting physical supply chains. Liquidity infrastructure strengthens adoption. It does not weaken it. Algorithmic trading introduces another layer of misunderstanding. Because price action sometimes appears mechanical rather than narrative-driven, investors assume that metals no longer respond to macroeconomic logic. But algorithmic systems do not eliminate macro influence. They accelerate its transmission. Liquidity shifts that once took weeks to appear in price behavior can now materialize within hours. That compression of reaction time creates sharper volatility, but it also creates clearer signals for investors capable of interpreting trend structure rather than reacting to headlines. Volatility should not be confused with instability. Often, it reflects increased participation depth. Silver's position inside this evolving market structure deserves special attention. Unlike gold, silver operates simultaneously as a monetary asset and a strategic industrial input. Critics often frame this dual identity as a weakness during economic slowdowns. Yet structural industrial demand is not cyclical in the traditional sense anymore. The electrification transition, semiconductor expansion, and renewable infrastructure deployment are long-duration capital programs rather than short-term manufacturing cycles. These sectors require conductive materials at scale, and silver remains one of the most efficient conductive metals available. This creates a structural demand layer that did not exist at the same intensity in previous decades. Rather than competing with monetary demand, industrial demand now reinforces long-term allocation relevance. Gold, by contrast, operates primarily inside the reserve stability layer of the financial system. Central banks do not accumulate gold for speculative reasons. They accumulate it as strategic insurance against settlement uncertainty and currency fragmentation. Importantly, these accumulation patterns rarely appear immediately in price charts. Reserve strategy unfolds slowly. Price recognition follows later. Another argument often raised against precious metals concerns geopolitical diversification flows. Some analysts suggest that sanctions regimes, trade fragmentation, and alliance restructuring may shift capital toward infrastructure, assets, commodities, or alternative currencies instead of metals. This interpretation misunderstands how protection ecosystems function. Capital does not choose a single protection asset. It builds protection layers. Currencies provide liquidity. Infrastructure provides resilience. Commodities provide supply security. Gold provides neutrality. Inside a fragmented geopolitical environment, neutrality becomes one of the most valuable characteristics an asset can possess. Unlike sovereign debt instruments or settlement currencies, gold carries no policy alignment risk. That independence becomes increasingly attractive as geopolitical uncertainty increases rather than decreases. Perhaps the most overlooked structural transformation supporting metals today is not visible in daily price movement at all. It exists in the gradual shift from a unipolar reserve framework toward a distributed reserve architecture where multiple currencies compete for influence simultaneously. In such systems, confidence becomes relative rather than absolute. And when confidence becomes relative, neutral stores of value gain strategic importance. Rather than weakening precious metals, the evolving structure of global currency competition and financial infrastructure is quietly reinforcing their role as stabilizing anchors inside portfolios, navigating a more complex and less predictable monetary environment than the one investors experienced in previous decades. A common conclusion presented in modern market commentary is that success in gold and silver now depends primarily on tactical flexibility rather than long-term strategic positioning. According to this view, investors should treat metals as rotating allocation instruments rather than core reserve holdings. This interpretation misunderstands the nature of the transition currently underway in the global financial system. When monetary regimes shift, assets do not become less strategic. They become more strategic. The modern investment environment is defined by three structural realities that did not exist simultaneously in previous decades: persistent sovereign debt expansion, permanently elevated central bank balance sheets, and the emergence of competing settlement architectures across regions. These forces do not reduce the relevance of precious metals. They redefine their purpose. Gold and silver are no longer simply crisis response assets reacting to inflation headlines or interest rate cycles. They are increasingly functioning as structural stabilizers inside portfolios navigating a fragmented reserve system. This distinction matters. Tactical positioning attempts to predict short-term capital movement. Structural positioning prepares portfolios for long-term shifts in monetary credibility. Investors who confuse these layers often misinterpret metals' performance during transitional periods. Periods of consolidation are not signs of weakness. They are signs of absorption. Another misconception behind the tactical-only interpretation of metals is the belief that capital always flows toward yield when liquidity conditions expand. While yield-seeking behavior dominates during stable policy environments, it weakens when long-term debt sustainability becomes uncertain. Yield depends on trust in repayment structures. Gold depends on none. As sovereign balance sheets continue expanding across major economies, the probability of structural yield compression increases over time. In such environments, reserve diversification becomes less about return optimization and more about exposure management. Gold sits precisely inside that exposure management framework. Silver occupies a complementary position. Unlike gold, silver benefits from both monetary relevance and industrial acceleration. As electrification infrastructure, renewable energy systems, and advanced manufacturing expand globally, silver's strategic importance increases alongside its monetary role. This dual positioning allows silver to operate across both protection and growth allocation layers simultaneously. Instead of weakening its investment case, this hybrid identity strengthens its portfolio function inside a world transitioning toward resource-sensitive technological expansion. Another important misunderstanding concerns the role of uncertainty in portfolio construction. Many investors assume uncertainty reduces the attractiveness of metals because volatility increases across asset classes during transition periods. In reality, uncertainty increases the value of allocation anchors. Portfolio resilience does not come from predicting which asset will outperform next quarter. It comes from maintaining exposure to assets that remain functional across multiple policy scenarios. Gold is one of the few assets historically capable of performing that role. Unlike sovereign bonds, it carries no default exposure. Unlike equities, it carries no earnings cycle dependency. Unlike currencies, it carries no policy alignment risk. That neutrality becomes increasingly valuable when the monetary environment becomes structurally uncertain rather than cyclically unstable. Perhaps the most important shift taking place beneath the surface of the global financial system today is not visible in price charts at all. It is visible in allocation philosophy. For decades, metals were treated primarily as insurance against extreme scenarios. Today, they are gradually returning to their role as strategic reserve complements inside diversified portfolios, preparing for currency competition rather than currency collapse. This difference changes how metals should be interpreted. Insurance assets are temporary. Reserve assets are permanent. Central bank behavior already reflects this distinction. Sovereign reserve diversification is not being implemented as a short-term tactical trade. It is being implemented as a structural adjustment to a changing settlement environment. Institutional portfolios historically follow similar patterns, slowly at first, then suddenly. Investors who interpret metals only through the lens of short-term price momentum risk missing the deeper transformation taking place beneath the surface of capital allocation strategy worldwide. The global monetary transition currently underway does not reduce the relevance of gold and silver. It restores it. Rather than signaling the end of the precious metals cycle, the emerging reserve architecture suggests the beginning of a new phase in which metals function less as reactive protection instruments and more as structural confidence anchors inside portfolios, adapting to a world where monetary dominance is no longer singular. Liquidity is permanently abundant, and trust is increasingly distributed across multiple financial centers instead of concentrated within one system alone. Understanding this shift is not simply useful. It is essential for investors attempting to position themselves ahead of the next decade of global capital movement, rather than reacting after it becomes obvious to everyone else.